Welcome to Market Call. I'm Marella Fernandez. Barry Schwartz on the show with us today. He's president and CIO at Baskin Wealth Management, and he's going to take your questions on North American large cap stocks. Here's how to reach us. Toll free, call 1-855-326-6266. You can email your questions as well. Market Call at bnnbloomberg.ca. Thanks for coming in.
We were talking about lunch, and I feel like tacos. It's Taco Tuesday.
Taco Tuesday. Well, it'll be Taco Wednesday tomorrow when the 25% up mark on the aluminum and steel happens, if they do.
Yes.
Let's talk about the TSX hitting record highs. What do you think is fueling the continued enthusiasm despite everything else going on?
TSX record highs, the all-world index record highs, really just the S&P and NASDAQ and the Russell are lagging. And that's probably because they outperformed for, 10, 15 plus years. There's good vibes. People are feeling good. The impact from the tariffs seems to be limited for now. We saw Q1 earnings come out from companies that were pretty decent. Those that told you that the tariffs are going to be bad were bad. But the bottom line is most of the North American economy is service-based, and the impact of tariffs is not material. We're seeing news headlines where Trump and Xi are going to speak on Friday. And so I think the market is feeling like the worst of the tariff threats are over. All the bad news has been delivered. Maybe some good stuff will start to come. Maybe we'll start to see some interest rate cuts in both Canada and the U.S. as we head into the end of the year. Inflation hopefully will start to come down to a more normalized level. Corporate earnings are strong. Summer is starting in Toronto.
Maybe it's the summer, the sunshine that
we got to feel good.
Yeah.
So this is what's going on. The market always climbs that wall of worry. It overreacted insanely in April. That was so dumb. And that was the opportunity. Now markets have gone back to a level, similar to where they were in January.
Okay, so let's talk about both the Federal Reserve and the Bank of Canada. Both of them have said we need to see some clarity about how the tariffs are working through the economy before we make any decisions on if and when we're going to move. Do you feel, first with the Federal Reserve and then for the Bank of Canada, that they've started to see that?
No, they have to see all tariffs removed, or at least coming to a consensus where there's a certain percentage of tariffs and what the impact will be. We haven't seen the impact of the tariffs on the inflation numbers yet. That will come. But there's going to be offsets, right? We're seeing declines in rental rates. We're seeing declines in other different products, commodities, gasoline, oil and gas is down. So it's hard. Economics is very hard to figure out. And if there's going to be a price rise in one asset class, there could be an offset or a decrease, or people will switch their demand for something else. And so I'm not too concerned about tariffs. I've been saying it all year. The biggest worry is what Trump is going to say tomorrow. But from what I'm seeing from our companies, they're adapting. They figured out what's going on with the tariffs for now. And we should expect a pretty good year for corporate earnings.
Okay. Do you think the Bank of Canada is going to cut tomorrow? Do you want to weigh in on that?
No, I think they'll probably hold steady. They'll probably want to wait to see when the U.S. starts cutting rates again. Let's keep in mind, Bank of Canada cut 7 times already. The one worry is the Canadian dollar has been really strong against the U.S. dollar. This was not what I thought was going to happen this year. They'll probably want to see how the employment situation plays out over the next few months. So I don't expect any rate cuts anytime soon. But as the inflation numbers start to come out the rest of the year, I think you'll see both U.S. and Canada cut 2 to 3 times.
Got it. All right. We're going to take a break, line up some phone calls and emails for Barry Schwartz of Baskin Wealth Management. He's taking your questions today on North American large cap stocks. We're back in a moment. Welcome back. Let's start with an email coming in from Chris. Chris says, Barry, may I please have your thoughts on CN Rail?
We were owners of CN Rail for quite a long time. We sold our position in 2024 at the end of the year. Partly worries about tariffs, partly worries about the management's ability to create value. We didn't like the fact that they were buying back stock using debt. We didn't like the fact that every time they would lower guidance after giving great projections. So it was a frustrating investment for us over the last 5 years. I don't think the stock has done very much. CP has maybe done a little bit better. The bottom line is the railroads are a heavy CapEx business, and the growth hasn't been there yet. The economy, as we know, has been insane, right? We had a pandemic, we had a lot of tariff worries, we've had a high inflation. So the whole supply chain has been messed up for quite a long time. Obviously, when you're dealing with concerns about tariffs, consumers, large manufacturers are unsure as to CapEx plans and spending. So you can see it reflected in the stock prices of the Canadian and U.S. railroads, but probably some good value here. I would say if you have a long-term investment horizon, probably not the worst idea to have a 1 or 2% position in the Canadian rails and just leave them alone.
Do you prefer CP over or CN, or do you have a preference?
Well,
there?
my opinion doesn't matter right now because we don't own any railroads. But at one point in time, I think CP Rail is still a better-run railroad, and it's more attractive in our opinion, the growth upside. But I don't really have any strong conviction either way right now.
Got it. Okay, let's go to the phone lines. John's on the line from London, Ontario. Hi, John.
Hello, Barry. Well, tariffs aside, thanks to a Trump bump, the data center model is back in place. So what do you need? You need real estate. They got plenty of that. You need energy. Meta needs power for its data centers. Do you think, aside from the deal they just made, do you think Cameco is going to do well because of Meta's need for energy? Thank you.
I'm super bullish on AI, and so I think we're going to run out of power before we run out of demand for AI. We're just getting started, and the caller's absolutely right. You need lots of energy, you need cooling, you need construction, you need labor, you need chips, you need racks, you need unbelievable amounts of equipment. And we just obviously hard to tell what the future is going to bring, and this is going to be a bumpy story. The demand for data centers is going to, ebb and flow with what's going on with the economy. Nuclear power, very exciting, obviously, but I would say it's unsure as to how quickly you're going to make money on those stocks, what the price of uranium is going to be. Clearly, we love Cameco here as Canadians. Great business, great operations. I haven't looked at the stock in quite a long time. We prefer to own natural gas via Tourmaline. We think that's the more stable play to provide energy and stable energy for data centers going forward. But I guess very excited for those that have bought the dip in April, May on Cameco. The stock's done amazing.
Yeah. Absolutely did. It did a pretty good job of bouncing back. Mm-hmm. Okay, let's go to Michelle, who's calling from Vancouver today. Hi, Michelle.
Hi, Morella. I'd like Barry's take on KKR. It's been kind of flat lately. Where do you see it going? Is there any upside? And is it a buy more, hold, or sell? Thank you.
Okay, let's get to KKR. Go ahead.
For sure. So there's a number of private equity publicly traded companies in both Canada and the U.S. The Canadians will, of course, know Brookfield and Brookfield Asset Management. In the U.S., of course, there's Apollo, KKR, and what's the other one? Blackstone. Those companies with the interest rates not coming down as fast as expected and with the volatility in the market, kind of concerns about is private equity deals still going to continue. And I think that's kind of past for now. Probably you're feeling good about private equity and growth going forward. All these companies are looking for ways to try and break into the retail market. Institutional investors own private equity, endowments own private equity, but retail investors are huge, and there's really not a lot of products. We expect to see a lot of liquid products being offered over the next 1 to 2 years from all these companies as they try to get exposure. BlackRock, for example, is buying private equity companies as well, trying to get into it. I don't really have a great opinion on KKR. The love of my life is Brookfield. We've owned it for quite a long time. They're very successful investors, and I like the fact that they have an operating business. They collect giant fees from a lot of diversified assets, and so it's our preferred play on alternative assets.
Let me ask you, because I was taking a look at KKR. So they started sliding right at the beginning of the year, sort of January, kept going down, and then hit that bottom. It looks like in April or when everybody else hit that bottom, and then started climbing back up. What would have edged it over at the start of the year? Just Donald Trump taking power?
Well, private equity is no different than any other, financial asset class. When the markets are rocking and rolling, everybody wants to own a piece. And when there's concerns that tariffs and the market could freeze up and who's going to do any deals and what's going to happen to inflation as a result of tariffs? Could interest rates go up, making private equity less attractive? These are a lot of worries right now for these companies. Also, you don't know what Trump's going to do in terms of taxation on carried interest and regulation. So a lot of headwinds, but I think obviously those are dissipating at the moment.
Got it. Okay, let's go get another caller in before we take a break. Daniel's on the line from Markham, Ontario. Hi, Daniel.
Hi, Marilla. Hi, Barry. My question is on TransDigm. What's your best tips in analyzing a fair price to buy the stock, and what attracts you long term? As usual, Barry Schwartz, one of the best on Market Call, and Marilla, great host. Thank you.
Thank you very much. Tell me about TransDigm.
Thanks, Daniel. Checks in the mail. TransDigm is a very interesting business. It makes aerospace parts. Biggest clients are Boeing and Airbus, but the bottom line is it sells a lot of those aftermarket parts to the airlines. And it's a serial acquirer. So it buys companies, tries to fix them up, tries to squeeze out higher margins. The airspace business is very hard to break into. Air Canada is not going to trust Barry and Marella
making their
parts
at home.
No,
Sure.
no, it's not going to happen, and we're not going to be able to compete with 3D printers. You have to trust the suppliers that are making parts for you for decades and decades. As for the caller's question about valuation, all the aerospace companies their valuations have gone straight up. If you look at GE, TransDigm, HEICO, a few other ones trading at multi-year valuations. Reason why is demand for air travel is exploding. And in some aspects, we're just getting started. Think of all the people in Asia and Latin America that don't even have passports yet that will one day travel. So we're extremely bullish on airspace travel. We're extremely bullish on TransDigm. We like the management team and its ability to really raise prices, keep costs low, and allocate cash flow at high rates of return.
Not a cheap stock.
It's the cheapest. It's kind of the cheapest of some of the of its competitors. Great business HEICO trades at 50 or 60 times earnings. GE is now trading at 40 times earnings. So these guys aren't cheap because of the certainty of the tailwinds of the airspace industry right now.
Got it. All right, we're going to take a quick break. Barry Schwartz sticking around. He's with Baskin Wealth Management. He's taking your questions on North American large cap stocks. We're back in a moment. Welcome back. Thanks for joining us on Market Call. We're going right back to the phone lines. Ron's on the line today from Regina. Hi, Ron.
Hey, good morning, Marilla and Barry. Hope you guys are doing well. I've been a holder of Almentation CoucheTard for quite some time, and I've been following trying to follow the negotiations that they're having to acquire 7-Eleven. Yeah. And I'm just wondering if Barry has some insight into what might happen to the stock if the deal goes through over the summer, or if it doesn't go through in the summer. So is there going to be significant price appreciation if the deal goes through, or if it doesn't go through, does the stock fall? Because it's been tracking sideways for quite a while.
Okay, so let's catch other people up just so they know. CoucheTard is having discussions with the Japanese owners of 7-Eleven, trying to purchase the American 7-Elevens, but
the whole shebang.
The whole shebang, but they'd have to get rid of some, right? Because they would own too many. So it seems like the Japanese owners have been resistant to this deal, but they have made a little bit of headway. What's your thinking?
At least they're talking now. And so before they wouldn't even have a conversation with the CoucheTard management team. Now at least they're talking, and they're trying to work together to figure out how they can get regulator approval, because this is the biggest concern. If CoucheTard is successful in acquiring 7-Eleven, it will get 80,000 more stores, and a bunch of them in the United States.
It's baffling how much they would control.
So CoucheTard, I think, owns around 15 or 16,000 now, so it would be pretty much near a monopoly in the United States. So they would need to figure out which locations could be sold off, who would buy them. That's a distraction, and I think what's happening with the stock, bottom line is, as soon as I bought it, the stock went down. It hasn't. I just started buying it we started buying in August of 24 for clients, and it's gone nowhere. So it's pretty disappointing. But one of the issues is really they're wrestling with a low-income consumer who's having troubles with inflation and higher prices on goods and trading down. They're buying, instead of the higher priced energy drinks or the higher priced cigarettes or beer, they're trading down. And that hurts CoucheTard's same store sales growth, right? They make more money when you buy higher priced products. in our opinion, this is like heads I win, tails I win situation. If they get 7-Eleven, I know they're wonderful operators. I know they'll be able to improve the operations and in a very short period of time pay back all the debt that they would use to acquire 7-Eleven. If they don't, they're going to make other deals and they're going to start buying back a ton of stock. There's very few bargains in this market right now. CoucheTard is an absolute bargain. We have to get through the temporary issues of what's going on with the U.S. and North American consumer. But I think once we're past that, this is going to be a compounder like it was for many, many years on the Canadian Stock Exchange.
Got it. Okay, so that's for CoucheTard. Let's go back to the phone lines. And Rocco's on the line from Montreal today. Hi, Rocco.
Hi, good afternoon. Congratulations, Barry, on your nomination as president of Baskin Wealth. I've been following you for years now, so congratulations. My question is on Parkland. As you know, you tweeted that there's an offer on Parkland. I just find it's a weak offer. Can you give me more information on this? Do you think we should tender this offer, or you think there's going to be a counter offer? So what's your plan going forward with Parkland? Thank you.
Yeah. All right. So Parkland, they have the activist investors, yes?
They have an offer by Sunoco. It's a limited partnership in the U.S. They've offered $44 a share, partial cash and stock. It's not the greatest offer for Canadian investors because it's going to be a taxable event, right? We always like when Canadian stocks get taken over with, either they relist the shares on the Canadian Stock Exchange or you can defer the capital gain. I don't think anybody has a capital gain on this stock anyways. It hasn't done anything for years. We own the shares. We also own a significant portion of its bonds. Obviously, we're pleased the stock has picked up lately. I don't think there's going to be a competing offer because this is such a mixed-up company. There's so many different parts. I don't think it appeals to anybody but Sunoco. Sunoco did offer $44 or $46 a share a few years ago. The Parkland management said no. It's kind of disappointing that they come back with the same offer, and Parkland now says yes. So what would I do with the shares? I would just tender and move on. There's probably better upside here, and I would recommend, like I said, CoucheTard. That's the more attractive, well-run business. Parkland was a well-run business for a while, but clearly lost its way.
Got it. Okay, let's go to Bob from Bowmanville, Ontario, with his question today. Hi, Bob.
Good afternoon. Barry, I'd like to ask you about John Deere, a company obviously we all know, very well run. Nothing but up for this company, it seems, both short-term, long-term. Do you still think this would be a good entry point for it?
It's not one that we own. We've always looked at it and hum and hawed about it, but clearly, if you look at the long-term chart, excellent business, excellent operators. And we all need to eat. And what John Deere is going to focus on going forward is autonomous vehicles for farming and agriculture.
Interesting. Okay.
And so that's the next leg up of growth for it. It can essentially sell software to farmers as well as the equipment, and they're very excited about the future of farming and how that's going to look more efficient, right? Instead of relying less on labor. Valuation, I mean, this is one that's going to obviously ebb and flow with what commodity prices, food prices, the economy, of course. And so we tend to stay away from a lot of commodity-based companies, but I'm excited to see the transformation of this business to more, I guess, software-related.
Got it. Interesting. All right, Bob, I hope that helps you. Let's go to Paul, who's calling from Toronto with this question. Hi, Paul.
Yeah, hi, ma'am. Just wanted to know about Tesla. Like it is, in the range of 330, 360 for the last 2 weeks. So could you get your thoughts on what is the good entry point on this? And thank you so much.
Okay, so it was at 480-ish. At its height, it's dropped off, obviously. There's been a lot of controversy around Mr. Musk. Do you think, is there a recovery for the stock now that he's going back to the business?
Well, it's recovered since the summer, and certainly the market capitalization based on the amount of profits that it generates is extremely high, is trading at an extremely high valuation. It's a cult stock. It's one where you can't really value it on today's earnings. You really have to hope that the battery technology takes off, that they can sell their software, that robo-taxis becomes a huge thing. They have a lot of irons in the fire. You don't know what Musk is going to come up with next. Is he going to merge some of his companies together? So, I mean, if you believe the Musk hype, this is one that you have to own. For the rest of us who can't get our heads around valuation and current free cash flow, it's very hard to buy the stock. but I can understand why people get excited. You know, there's a bunch of names like this, Palantir and Carvana, that, you know, they just traded valuations that are ludicrous, but sometimes for good, you know, that works out for good reason, right? Yeah. The growth eventually comes, and you wonder why you didn't buy them and pay 800 times earnings.
Yeah. Okay. So that was Tesla. We do have to take a quick break. When we come back, we'll have a look at Barry's past picks. We're back in a moment. Welcome back. It's time now to have a look at Barry's past picks from June 7th, 2024, so almost a year ago. At the time, he picked CoStar Group on the NASDAQ, an investment company that does MSCI is the first one we're going to go to, which was recommended at 491.69, now up to 562.72, so Americans are a 14% upside return and 16% total return. Investment analytics, as I was saying.
Yes.
Is this a company she'll like?
We love it, and it's one we intend to hold for a very long period of time. As you mentioned, it's investment analytics. It sells proprietary data for financial services companies to report their returns and benchmark. Highly necessary product. They own thousands and thousands of these indices, MSCI, right? We all heard of the MSCI China, but there's MSCI on so many different international indices, some with dividends, some equal weight. Like it's insane. And so if you're a hedge fund, a mutual fund, ETF, and you want to compare your performance against MSCI, at an index, you have to pay them a license, right? And so that fee goes up every year. And
I was going to say, is there growth for them? But if the fee goes up every year, they're getting growth there.
Well, there is growth, and as financial markets add more products and services, so the next leg up of growth is private equity, is alternative assets, right? We need benchmarks. We need to be able to compare, right? So you have this equity fund, private equity fund. How do you compare against the index? What index should we use? MSCI is working on, as well as Moody's, trying to work on different products to benchmark, and we think there's lots of upside there. So the good news is international markets are really, really strong this year, and MSCI, which benefits from mostly international, should have an excellent year.
Got it. Okay, let's go to the next one, which is CoStar Group, which does commercial real estate analytics information. Yep. So at the time, it was 76.21 American. Now it's down to 73.10, a 4% drop in return and total return. Did it take a hit like everything else, or what's playing into this?
There's a couple things going on with CoStar that's not really related to what's going on with the economy. CoStar has one of the best businesses in the world. It's like the Bloomberg of real estate analytics. Sells similar to MSCI, sells licenses, sells subscription, amazing business, high returns on invested capital. The other part of its business, they're trying to compete against Realtor, Zillow, Redfin, create a website where they're trying to get more agents to list their houses. They have spent $800 million. Sorry, they spent a lot of money. I don't know the exact amount, but they've spent a lot of money on it with no profits yet. There's an activist team on board that wants the management to either figure it out by the end of the year or move on. So similar to what I mentioned about CoucheTard, we think this is a tails I win, heads I win type investment. The current business is doing amazing. Either the homes business, homes.com business takes off and starts to improve and show profits, or they cut it off and they start reinvesting the cash flow in other companies. So we think the valuation is very attractive here for one of the best businesses in the world.
Got it. Okay, let's go to Visa, a well-known brand, of course, recommended at $278 US at the time, which was June of last year, and now it's at $364.61, upside of 31%, upside of 32% total return. Visa just continues to barrel forward. You can't really push them down.
You know, I had a client who owned a restaurant, and when Visa went public, the client called me. She said, all my transactions are with Visa cards. This was, of course, 15 years ago. And she said, buy me a lot of the stock. And I said, well, we don't research it. She said, well, just please buy it for me. So we bought it. And then I finally smartened up and bought it a few years after her. I think we paid about $75 for it.
Oh, wow.
But we're not getting rid of Visa. I mean, this is one of the best. Well, I use the best business of the world, but this is another great business model. As you know, it's a network and benefits from the growth of consumer spending, benefits from inflation. They reinvest the cash flows at high rates of return, getting into so many areas, B2B, B2C, you name it. And we just think the sky's the limit for Visa over the long term.
Do you worry about downturns in the economy and people holding back on using their credit at all?
I mean, that's going to affect earnings and quarters and year to year, but the long-term proliferation of people using more Visa cards, shopping online, using less cash, the world is still mostly cash, so we think there's just so much upside to go for Visa, and how that's going to play out, hard to see, but the tailwinds are just so excellent.
Got it. All right, we're going to be back with Barry Schwartz to take more of your questions on North American large cap stocks. Back in a moment. Welcome back to Market Call. We are going right back to the phone lines. Chris on the line today from Calgary. Hi, Chris.
Good morning. My question is with regard to Brookfield Corporation. That's Bravo November. Bought it started 2024, and it's done really well up until the start of 2025, where it's been floundering around here for 4 or 5 months. And I'm just wondering what you think about Brookfield on a go-forward basis. Thank you.
So Brookfield Corporation currently sitting at 58.55. You like Brookfield?
I do, and shout out to Calgary. I was there last week visiting clients. Beautiful weather there last week. Wish I took my golf clubs, but had to do work. Brookfield, floundering this year. I mean, unless you own Nvidia or some of those hot growth stocks, it's been a very tough year for North American markets. But long term, Brookfield obviously has a terrific track record. I think it's compounded shareholders' capital at 18% over the last 30 years. Sorry. So terrific track record. You look at the management team, own a significant stake in the stock. But really, where's the growth going to come from going forward? And I think it's still more their ability to sell and market new products, distribute new products to, they just have such a great track record and the ability to launch products in insurance and real estate and private equity. And you never know what they're going to come up with next. Given the fact that markets have been volatile, I think that's going to work into Brookfield's favor. Well, I don't know why I was going to say flavor, but I think it's going to work in their favor in terms of maybe more money is going to be looking for less volatile type investments. And, the next leg up for growth, just like I mentioned for KKR, is selling more private alternative investments to retail investors. That's the next coming wave. It's going to be huge, and Brookfield's there already.
Got it. Okay, Brookfield, one to hold on to if you do have it. Let's go to Jazz from Mississauga, Ontario. He has a question. Hi, Jazz.
Hey, good afternoon. Thanks, Morella. Thanks, Barry, for taking my call. Just a general question on, tariffs aside. How about what are your thoughts on maybe this potential changes to the U.S. tax law, where non-U.S. residents, specifically us as Canadians, what we could face with a higher withholding tax rate potentially? What would you say to Canadian investors who maybe have U.S. investments or maybe looking to invest in the States going forward, just generally speaking, with this potential change?
What's scary about the One Big Beautiful Bill is that it's going to go up 5 percentage points every year until it hits something like 50%. The bill hasn't gone through yet, but is this something you think is going to happen?
Well, I'm more freaked out about what's going to happen in 2027 if Carney brings back the capital gains increase, right? So, if you're rich, get used to being taxed more because North America is broke and the deficits are out of control, and spending has got to continue, right? I saw today that Carney wants to fast track a ton of infrastructure spending. Where's this money going to come from? So it's going to come from the taxing the rich. So, this is what's going to happen. Is it impactful? Is it going to change our investment decision at Baskin about buying U.S. stocks? Absolutely not. We don't buy them for the dividends, right? And so if you want to tax me more on withholding tax on dividends, fine. I barely own dividend-paying companies anyways. It's not going to change the long-term ability of whether we're going to be using more or less AI in the future. I'm focusing on long-term trends of the companies that we own, less so on taxation. And a 5%, I guess Canada Canada could get rid of this higher hike by giving into the digital media tax. I don't know what negotiations will lead to, but maybe Trump will taco this one too.
Yeah, and I guess it depends on, as you said, what negotiations happen in trade, and that might get pulled back depending on what Canada has to give. But that's still, a year and a half away.
For sure. I can't worry about what's going to happen with taxation a year and a half away. Got to worry about what's going to happen today.
Got it. Okay, let's go back to the phone lines. Nazar is on the line from Scarborough, Ontario. Hi, Nazar.
Oh, hi, Marilla. Hi, Barry. May I have your thoughts on Air Canada, please? The stock fell below $15 and is now trading just under 20. Air Canada has offered to purchase shares under a Dutch auction for not exceeding $21. Does this suggest that the stock will be range bound for some time? I heard your comments earlier that you are bullish on travel industry in general. Thanks for taking my call.
Okay, thanks for the question. So Air Canada has really struggled. Their stock went down to lower than it was during the pandemic when no one was traveling. So is this a stock you'd invest in?
The airline business, you were bullish on travel. I mean, it's one that you could see 3 to 5% growth over the long term. That doesn't necessarily mean that you can make any money on the airlines, right? It depends on the business model. Airlines are notoriously terrible businesses, and good
tight margins.
Tight margins. They always have to buy new planes, upgrade their planes. A lot of capital expenditures. They don't make a lot of money unless they sell out the planes, of course. And when there's tough economic times, geopolitical times, then travel slows down. And so they're trying so many different ways to raise fees, right? Soon we'll have to pay for checked baggage, probably have to pay to use the bathroom, pay to get a drink of water.
I would not doubt it.
Yeah, God only knows, right? Or we'll be standing like cattle, 1 inch of privacy. I was on the flight from Calgary, WestJet, they used a Sunwing plane, and I was stuck on the tarmac for an hour and a half. But I didn't complain, and because I was happy. I own TransDigm, and I see the demand at if you've been to the airport lately, they're wherever they're all packed. So I can't buy airline stocks. I just don't like the business. I don't think Air Canada has a sustainable business model to generate long-term growth, and so I would avoid all airlines for our portfolio.
Got it. Okay, Barry Schwartz sticking around. He will take more of your questions when we come back. Stay tuned. Welcome back. Thanks for joining us. Bob is calling on the line today from Brighton, Ontario, with his question. Hi, Bob.
Hi. Thank you for taking my call. Great show as always. And Barry, congratulations on your new appointment. I'm calling about BCE. Can you give me your thoughts, please?
Okay, so BCE, of course, parent company of the channel under the Bell Media brand, long-suffering stock here.
Yeah.
They recently cut the dividend, didn't really get much of a bounce from that.
Stabilize the stock, though. And it was the right thing to do, and everybody knew it was coming. And when the dividend yield, here's the bottom line. When companies have dividend yields at 8 or 9%, that's not sustainable, and a dividend cut is coming at some point in time. And the market smelled it out. And why is the stock going down? Because the business model is facing a lot of challenges right now. So much competition, let alone new competition. Starlink, we'll see what Amazon and Google launch, right? Everybody wants to get into satellites and compete against the telcos. The telcos are facing competition on mobile. Fewer people are signing up for TV, right? No, my kids don't watch cable anymore, right? Only if they watch in the Raptor games, and the Raptors are so bad, I don't even know if they're going to watch Raptors anymore. The broadband business is going to face challenges. You can see it in the fundamentals. The company's not growing. The revenues aren't growing. I know they're looking for alternatives to try and break into the broadband market in the U.S. Good luck. That doesn't seem like, to me, a smart decision. But this is a company which has a man with a hammer problem. They're in the media and telco business, and it's a terrible business to be in right now. Cutting the dividend is the right move. We would like to see them work down the debt, maybe sell off some ancillary assets that are not creating a lot of value. And, I think the media business did quite well this quarter, so that's positive. But it's hard to see a way out of the stock, hard to see a catalyst. We don't own any telcos for clients and no plans to buy any anytime soon.
All right, Bob, hope that helps you out. Let's move on to Sal from Toronto. Hi, Sal. Sal, are you there?
Hi there. My question's on First Service and Corp. It's historically been a good compounder. 2025 hasn't been that great for the company, and I was just wondering what your thoughts are of the company and if you think now is a good entry into the stock. Thanks so much.
Okay, thank you for the question. First Service.
Yeah, I think one of the issues with First Service, if you look at the chart and the long-term chart, it really compounded its way into an extremely high valuation. Probably hit a too high a price in 2021, 2022, when everybody was excited about low interest rates and YOLO free money. But First Service is a well-run business, great serial acquirer. We know it's in the property management business in North America, and as well trying to get into the renovation business and the business where it helps commercial and residential when there's fires, floods, hurricanes, that kind of thing. And a lot of its businesses are lumpy, right? Renovation and the hurricane business depends on if there's hurricanes or not. The property management business is the gold standard. It's just really about valuation. I think market is waiting for the earnings to catch up for the valuation. We plan to hold this for an extremely long period of time. They got into the roofing business. We think that's going to be a home run for them. And we see many, many more acquisitions for them into a lot of different areas. So First Service is an investment we've owned for about 10 or 11 years and hopefully own it for longer going forward.
Got it. Okay, let's go to an email then. Dan says, I would like to have Barry's thoughts on Adobe right now. Adobe also struggling. Is it with their subscription? Are people not picking up their subscription to their services, or what is their struggle? Competition?
It has nothing to do with fundamentals. So we bought the stock around $400 in 2022. When I bought the stock and I look at when the earnings are today and the expectations, way better than I thought. The company's still growing, top line and bottom line at double digits. It's now spewing off a lot of free cash flow, buying back stock, great balance sheet. The issue is really worries about the future. How is AI going to affect their business? You saw the other day the announcement by Meta. Upload a picture of your product and we'll create a whole digital strategy for you. You don't even need an advertising agency anymore. I mean, that's great for small businesses. I don't think that Coca-Cola is going to trust that device. So the worry is, are creatives going to be using alternative products? Are they just going to ask AI to do it for them? And that's been weighing on the stock. No evidence yet that it's impacting any of its results. And Adobe is obviously in that space, right? They are coming out with their own generative AI products. But the market is not respecting the fundamentals at the moment, and maybe rightly so. It's hard to tell the future.
Okay. Adobe, a lot of questions about what AI can do and whether it'll steal from them. Okay, let's move on to Joan from Richmond Hill. Hi, Joan.
I'd like to ask the gentleman about the Bombardier and what he expected this move up or down, and what is the best price to get in this stock, please?
Okay, thank you for the question, Joan. So Bombardier today is at $95.76, so it's up almost $2 just on the day. But Bombardier has seen some growth as people seem to want luxury jets.
Oh yeah. The demand is off the charts. It's really the bump on the road right now has been the worries about tariffs, right? Sourcing parts, selling their products to other countries, and how that's going to impact. And so worries about higher steel and aluminum prices, and I guess those go into making. But I mentioned the demand for aerospace parts off the charts, growing very, very strongly. Bombardier is a much different business than it was 10, 20 years ago, pre 9/11. So it's generating now a lot of free cash flow. The balance sheet is improving rapidly. It's just a very tough, manufacturing is a tough business to be in, and I'd rather own a company like a TransDigm or a Heiko, where I have more certainty on what the future is going to look like, than depending on whether they're going to sell, Bombardier sells more jets in 26 or 27, and if a recession happens, what happens there. So I'd rather not invest in that type of business.
Got it. Okay, let's get to one more email before we have to have a break. Dennis has written in, Barry, I've always found it easy to buy a stock, hard to sell. What's your criteria to sell a stock? Okay, so I'm sure there's a lot that feeds into
question.
that. A, do you need the money? Or when do you need the money? But what else do you think about or consider when you're going to sell?
So I always tell clients, if you need a large amount of money from your portfolio within a year, get it out of the stock market, right? Because anything can happen. You can have an April 2025. You can have a pandemic. You don't know. When I sell a stock, I sell because I found a better investment idea. I found when the management team does something that we don't think is creating value any longer, or when we're just or when the fundamentals don't prove out anymore. And sometimes I've sold a stock because the company's buying back stock with debt. Their balance sheet is getting worse. The revenues are not growing as fast as they used to, or even going negative. Companies having severe problems, balance sheets worsening. A lot of reasons to sell a stock. The reason to not sell a stock is market volatility. That I will never sell a stock when the market goes down, or someone's pounding the table and telling me the S&P is going to go to 3,000. I don't care what those people say. I'm a long-term investor. I focus on the fundamentals. I hold the stock if the fundamentals are improving or if there's a temporary issue, but I know it's going to be solved and the fundamentals will come back.
Yeah. Okay, that's good advice. Take the emotion out of it, they say. Look at the fundamentals. That's all the time we have for phone calls and emails, but stay tuned. Barry will share top picks coming up. Welcome back to Market Call. We're going to take a look at Barry's new top picks. We're going to start with Apple. And I'm wondering why, out of the Mag 7, Apple is your choice. Everybody has their reasons for a certain tech stock comeback, but why Apple?
Well, the sentiment is so poor right now on Apple, right? So if you go on Twitter, the market narrative is Apple's losing in AI, Apple's facing tariffs from China, Trump is threatening them, you name it. There's so many issues that Apple's facing. The growth is not as robust as it used to be. I'm looking forward. I'm looking forward to an Apple finally unleashes AI into its products. And what I see in the future is we'll all have these AI agents, namely Siri, that will do a lot of different things for us. All the things that were so lackadaisical we put off, we can have AI do it. Set up doctor appointments, take our kids, whatever it is that we don't do, that we should be doing, I think Siri will eventually do. And it's a closed system, 1.1 billion users of Apple products daily. We think they're going to sell more products and services to customers over the long term. It's one of the best businesses in the world, generating a lot of free cash flow, and the valuation is as attractive as it's been in a long time.
I just had the thought of your doctor's AI agent and your AI agent both battling out together to try and find.
For sure. Get me that MRI within a year, please.
Within a year, yeah, that's lucky. Okay, let's go to Berkshire Hathaway, which is your next pick. An expensive stock. You like it moving forward, even though Mr. Buffett's retiring at the end of the year.
It's expensive on the price, but on valuation, we think it's more or less, fair value. Stock ran up, I guess, when a lot of volatility in the market. Berkshire's always a safe haven. Sure, Buffett is retiring. It's the end of an era, but we think Greg Abel has the chops. He's an excellent operator. He's been at Berkshire for a very, very long time. We're excited to see what he'll do with the cash balance, how he'll improve operations. We think insurance stocks have pulled back lately, so this is an attractive opportunity to get back into Berkshire Hathaway or start a position for those that haven't.
Do you think he has the same sort of vision? I know he's trained with Mr. Buffett for a long time, but does he have that same sort of vision and appeal to investors?
Buffett says he's got the capital allocation skills that he has. Obviously, Abel is not a stock picker, but Buffett was never a great business operator. So I think what Abel brings to the table is better business operations, maybe not as great stock picking, but Berkshire is not really so much a stock investment company. It's an operating business, right? Railroads, insurance, energy, huge businesses. And so we think a great proxy for the growth of the U.S. economy, and will really benefit from this AI and electricity demand trend.
Got it. Okay, let's get to your next pick, which is Constellation Software on the TSX. Constellation, they do a lot of acquisition, right? Tell me why you like them moving forward.
Absolutely. Constellation is an acquirer of software companies, owns 1,000 software businesses, has spun off 2 of its businesses already. Topicus and Lumen. Those trade on the venture exchange, and we see more spin-offs to come as it uses its stock to acquire other large software businesses. We think there's just so much growth going forward as Constellation Software acquires more software businesses, as well as looks to get into other areas. I know we don't have a lot of time, but we did a podcast on the long-term investing podcast with Baskin Wealth, where Ernest and I did a deep dive on Constellation Software. Check it out. And we talked about 40 minutes on why we think the growth is, the end of Constellation growth is not happening anytime soon.
How many acquisitions do they do roughly a year? Are they acquiring all the time?
Yeah, the goal is to acquire. They're going to generate about $2 billion of free cash flow, and they'd like to put that $2 billion to use in acquisitions. Some acquisitions they make are $1 to $2 million revenue companies. Some are multi-billion-dollar companies. It really just all depends on what's available. Obviously, given its size, one of the largest companies in Canada now needs to be more aggressive, making larger acquisitions and coming up with financial engineering ways to spin off companies, or even getting into other areas outside software. But I trust Mark Leonard. He's the best capital allocator in the world. And as a long-term investor, you want to partner with great capital allocators. That's how you make a lot of money.
Got it. All right, Barry Schwartz, thanks for coming in. Good to see you. We'll see you again soon. And thank you very much for joining us here on Market Call today. We'll see you again tomorrow. A quick look at the markets as we head to a break.